There's not going to be any rate increases. That's patently ridiculous. We have an incompetent Fed that can't forecast their way out of a paper bag. Because once oil starts going down, it trades with momentum. And so it's really not a great call to say, oh, well, it's going to stay elevated, that 85.90, which there was a ton of people doing that about a week ago. But there's still a lot of pundits who are, saying, oh, well, inflation is going to stay elevated. We think that's ridiculous.
Talk about in the money. Boy, did you get it right. We spoke to you on March 12th, and I wrote down notes from that interview we did, Jay, in which you said, look, at its worst, oil would go to 140 a barrel, which it actually did not, with gas around $6 a gallon in the New York City area, about $5.50 for the rest of the country, which that was accurate. But you also said oil would be in a trade in a range of $80 to $100, closer to $100, which you worried would be a problem for the economy. But you said when the Strait of Hormuz opens, you'll see oil drop down to around $60 to $70 a barrel. Today, WTI is at $69 and falling. Brent is down around $72, $73. So again, you got it right. Is it time for you to take a victory lap?
Well, maybe not. The data, and I always say the data is way more important than the opinion, because if I give you the data, you can draw your own conclusions. But the key insight, which is more clear now than it was then, is that OPEC is likely to go to maximum production. And so they normally do 29 million barrels. They could do up to 32. Obviously, Iran is going to want to go to maximum production, and they can sell it now broadly, their oil broadly. And that actually is consistent with oil 50 to 60. The part that we can't quite figure out, there's going to be a lot of headlines coming out of these negotiations. And so there's going to be some premium for the risk that the strait recloses. But definitely the risk is to the downside. The other insight that we may have been relying on more back then is once oil starts going down, it trades with momentum. And so it's really not a great call to say, oh, well, it's going to stay elevated, that 85.90, which there was a ton of people doing that about a week ago. I think they're probably changing their tune. But it is the reason that we obsess about it, and everybody should obsess about it, is that it's the key bull case for the stock market. There's not going to be any rate increases. That's patently ridiculous. We have an incompetent Fed that can't forecast their way out of a paper bag. So they didn't update their forecast for the fact that oil had dropped 25%. Now it's down 30. We're going to have two negative CPI prints. Core is going to be really low as well. And so there's definitely not going to be any rate increases, but we think there'll still be 3 cuts because you get shelter finally going towards market, tariffs rolling off, and the oil impact. So it's the key to really our 9,000 target, and our bull case on the market is lower oil prices. So the fact we've been correct so far, because now oil prices are down 30% from the last CPI print. It does take a couple months because they average it all to fully be reflected. But there's still a lot of pundits who are, saying, oh, well, inflation is going to stay elevated. We think that's ridiculous. The leading indicators of inflation are oil, obviously, has been the problem, and the money supply is negative. So we actually have a risk of deflation. And so that'll drive even a hawkish Fed towards rate cuts.
I want to just repeat, I want to get back to oil in just a second, but I can't ignore what you just said because you're an outlier. I mean, others are saying we're going to have a rate increase. And what I just heard you say is we're on target for 3 rate cuts. Over what time period are you looking at?
Well, to be fair, at the beginning of the year, we said this year, but we did not forecast the Iranian war. So we're just trying to be realistic. So say between now and mid 2027. And the reason for that, which is reflected in the fact that this super hawkish Fed has 2 rate increases. Of course, Warsh is not on those dot plots. And also, a lot of those dots are not voting members, but let's ignore that for now. But so there's clearly a hawkish Fed. Warsh has come out hawkish, sort of, to get credibility. So we're going to need real prints. They're not going to just have a heroic forecast. They're not going to just log on to our website and say, oh, adjusted inflation's already below 2, which it is. So they're going to need to have real data, and it's going to take a while for it to unfold. Like just even to get this oil decline reflected in CPI, it's going to take a couple months to get that data out, and then another 3 or 4 months to get the shelter component to finally be close to zero, which is what it really is. So government agencies move slowly, but the data is going to, and in our forecasts, require them to cut. And the notion they're going to increase, totally ridiculous. Keeping in mind, like, so we're going to have, like, let's say it's 3 months from now, 4 months, and we had 2 significantly negative CPI prints. They're not going to raise rates. It's ridiculous. I don't know how. The Fed funds market's pretty inefficient. I wouldn't really look at that. The 10-year has been really well behaved, and that's a global security that's super liquid. So 10-year it's rallying today. It's forecasting that we're more likely to have cuts than increases. So I would rely on the 10-year versus Fed fund futures. Very few people trade it. We do. We're long Fed fund Fed fund futures, but it's pretty thin, and it's usually wrong. It's a little bit like the dot plot. It's normally wrong.
Let me get back to oil from an investment standpoint and help me understand what I'm either getting correct or what I'm missing. I think one of the takeaways from this conflict with Iran is, yes, they may wind up controlling the Strait of Hormuz in ways we don't like, but it's almost as if the world has once again been thrust back into EV land. We're going to go back to electric vehicles, but also the Gulf states, are they not building pipelines to circumvent the Strait, which would, in a matter of years, it won't happen overnight, make Iran and the Strait perhaps irrelevant?
There's no doubt that those pipelines are going to get expanded. Part of the bear case, I guess, for oil, I mean, it's bullish for the market, was that nobody seemed to pay attention to the fact the Saudis were shipping an extra 3 million barrels through the Yanbu pipeline. That's the east to west pipeline. So that takes a lot of pressure. They're going to continue to do that in the near term, at least. And so that takes pressure off of how much oil has to flow through the Strait. Also, the Strait was really open for the last month at some level because the U.S. had opened up a southern channel. So we should, though, as you're pointing out, have a much more reliable oil supply because those pipelines are absolutely going to get built. And EVs and renewables are great for the environment, but they have a maximum amount that they can be increased, particularly in the U.S. And so they're going to continue to be an important source of power, but at the margin, it's going to be natural gas. Europe blew up their energy market by relying on just renewables because they're not, you can't guarantee the sun's going to shine, the wind's going to blow. So you need to have a balanced mix. So I just think that being more balanced, also in the short run, hybrids are the answer, and that's where you've seen the most demand, not electrics. If you go, I was in Vegas and renting a car, and other people, I had a reservation, other people didn't. And the reservationists kept saying, well, we only have Teslas. And nobody would take them because they didn't want to die in the desert. If you're in Vegas, you're surrounded by a desert. So they're not very practical right now. They will be in 5 to 10 years when the range goes up to 1,000 miles or more. But so the short run, you're seeing tremendous demand for hybrids. That's great for the environment. So it's just important to be practical. So this will slowly develop. You get a little bit more nuclear, you get more renewables. But the notion that we were going to wipe out natural gas in the short run, not a good idea. Natural gas replaces coal, which is an abomination. And that's really why the U.S. has been the leader in cutting carbon, is not because we're great environmentalists, but because we have a lot of natural gas that displace coal. So I would just be balanced. It's not going to be EV nirvana. We need better technology on EVs to really have them be ubiquitous.
So let me wrap up asking you this. I want to reiterate. You believe over the next roughly 18 months, we'll see 3 rate cuts from the Fed. You also, the price of oil never really got above $100 a barrel. And that spoke volumes to me, because that was the panic, as it always is the panic, that we would see these horrific oil prices. But 20 years ago, we saw horrific oil prices at the beginning of the financial crisis. And people said then peak oil, and it wasn't. But I'm wondering, if you and I speak in June of 2031, if we speak in 5 years, if oil and Iran are even part of the discussion.
I agree with you. I think we're lower for longer. Again, if OPEC produces at maximum levels, which they will in the short run, partly because they need the money, but partly because the Trump administration is going to want them to, we could have $50 oil. The world, mostly because the U.S. has such robust energy resources. I would urge everybody to go on our website and look at it, and you can just Google it, a map of the United States 70 million years ago. The gigantic ocean that divided North America. Oceans is where hydrocarbons are born. Algae is what forms it, and plankton. So we have more natural resources, including Canada, than the rest of the world by far. And we're going to have abundant oil coming out of the U.S. and natural gas. So it should keep a lid on prices. And also, we don't have the boom busts we used to. U.S. producers would ramp production way up and then it would crash. So it's going to be more stable. And, the renewables will over time take market share. So I think lower for longer is the most likely case, as you're implying.